Yo, keep me activated. Yo, shout out Modelo. Yo, don't get the variety, get the regular, boys. So today I'm going to cover another one of my favorite books. This book is called The Intelligent Investor by Benjamin Graham. And this book is pretty much how to be a smart investor and what to look for. So I'm going to cover some key points in it. So one of the things it says is like investment is most intelligent when it is most business-like. And also, you have to know what you're doing and know your business. But another concept is you have to keep away from things in which you have little to gain and much to lose. So last time I was breaking these bad boys down, but I'll let people interpret that for themselves, and I'll break some other parts down. So there's something called the margin of safety, right? By refusing to pay too much for an investment, you minimize your chance of your money suddenly being gone or disappearing really fast. So for example, like all these stuff are gonna connect, but let's just say Amazon is at like an all-time high, right? Let's just say it'd be like 4 months ago it was like, let's just say it was like at 600. Now it's like, then let's just say it went to 700 and buy, 800 and buy, 900 and buy, 1,000. You're like, F it, man, I don't want to miss out. But if it keeps on going up, then let's just say you bought right there, right? So that is not the margin of safety. Now it's at an all-time high right there, right? And you don't really know what's gonna happen. It could go up, it could go down, right? So let's just say you bought at 1,000 now, right? That's not a margin of safety. Now let's just say if something happens, it drops back. Let's just say you put your money, let's just say you put whatever in it, right? Then it drops back to like 600. Or like let's just say it drops to 700, 800, right? Right there, you just lost thousands of dollars, and for you to break even, it literally has to go back to 1,000. So, but what goes up must come down. So it's all about timing it. So if you know okay, another part of this book, right? I'm just gonna skip around. It's like the best time to buy a great business is during a bear market, which means like when everything is crashed. So technically, like right now, how everything is just down, down, down. So if you look at most things right now, right? If you compare it to like their 3 months high or their 3 months period, 6 months, they're all down. So the best time to buy a great business is during a bear market. So that also goes with the margin of safety part right there. So from that perspective, like, let's just say you know the business. So Amazon was one at whatever. Let's just say Facebook, for example, right? So Facebook, everything is pretty much down right now, right? Let's just say like the target price is like at like just say like 200, and right now is at like 133. So right there's a good margin of safety because that's a great business that has a great I'll get into that more, but at least you guys get the point of what I'm trying to say right there. So for example, right? Do not let anybody else run your business or your stocks or your cryptos or your NFTs from the perspective, like, unless you really, really trust them, unless they went to school for that thing or have knowledge on it, right? But let's just say so this book is not going to get you to the whole entire vibe, but for example, if you research, you have to research what you're doing, for example, right? That's why it says investment is most intelligent when it's most business-like. So nobody in a business goes into an investment or buys stuff while doing like knowing their price, their inventory, and all that good stuff, right? So if you form a conclusion based on facts, you have to act on it, even if other people don't think so, because you did your research and you're right because your data is correct. So if you know about the price, price over book, price slash earnings, return on equity, and all that good stuff, and their debt ratio compared to cash, or their all that good stuff. So, but once you know, so you have to know stuff like that before you buy stocks, for example, right? So if you actually do your research and understand the stuff behind that, then you have to act on it from that perspective because you did your research. Let's just say that it passes all your research tests, right? The one time you could be wrong if you don't do it by the margin of safety from that example, right? If you could buy at a high, which could be like, you're not necessarily wrong, but your return would be lower, and which makes you at a bigger risk. So for example, another thing is before you invest, right, you have to realistically assess your probability of being right and how you will react to the consequences of being wrong, which is a key. So like if you put money into something, right, you gotta think about the other perspective. What would happen if you're wrong? Let's just say you were like setting like market stops or stop losses and all that good stuff, right? To minimize your chance. That's one way to minimize your chance. So if it goes below a certain price, it sells, for example, right? But you have to realistically be like, what would happen? Let's just say if you lost all your money. So that's why you don't put stuff in that you can't get out or that you really need. So you have to buy, what's it called? Buy shares in a few high quality stocks, cryptos, or NFT projects at a fair price and hold them. But another key thing is once something goes up, like you have to take profit. You can't just live in an imaginary world. Oh, it's gonna keep on going up. It's gonna keep on going up. It's keep on going up. If you put 5,000 and you made 10,000, take 2,000 out, put in your savings. If you really believe in that company, it's gonna drop down sooner or later. Then once it drops down, reinvest that 2,000 you took out into the same thing or invest into something else. So yo, let me take a break for a second, boys. Gosh damn. I'll be damned. So right now, those are some very key facts right there. So, for example, I'm gonna tell you guys how to spot a good business and how to what a great business does not look like. So to spot a great business, you gotta look for a simple business with consistent performance and favorable long-term prospect. And before you invest in the company, you have to understand the product or services it provides. For example, a great business has excellent brand recognition from the perspective of like everybody knows what Amazon is, everybody knows what Target, everybody knows what Facebook, everybody knows what Tesla and all that good stuff. So those are great businesses. Some could say that it's already too late to invest, but it's never too late to invest if it passes your research test and if you use the margin of safety. And so that means you're buying at a better time or doing a bear market, for example. So what's it called? Like when you're researching a company, you got to ask yourself if this company, this is how you spot good business, right? If this company was selling the same product, let's just say 10 years ago, and if it would be selling the same thing 10 years from now. Because if it wasn't selling the same thing 10 years ago, that means it's changed. And if you don't think it's going to be selling the same thing 10 years from now, that means the business might crash or go down. And from that perspective, it's like, ooh, that might be a bad business unless they're changing their model, for example, which is possible. Like let's just say like a company sold like beer, right? And like randomly against the cigarette market. That would be okay from that perspective, but they have to keep on selling their base products. So a great business is usually one that like the customer or consumers or whatever, right, will have to keep on purchasing over and over and over again. So from that perspective, like people will always have to purchase like simple stuff like toothpaste. So if you find a business that was selling great toothpaste, like because everybody has to rebuy that over stuff like candy, coffee. So Amazon's good business because not Amazon, Caribou is a good business because they're selling stuff that would never run out of style. For example, coffee would never run out of style because it's one of those things that people love, and I guess there's like an addiction part to it because people can be addicted to like caffeine. So like the more addicting, the better it is from that perspective. So stuff like, but see what I'm saying? Like candy, people are always gonna eat candy and they're never gonna stop. People are always gonna buy toothpaste. People are always gonna drink soda, and people are always gonna do so just simple stuff like that. That Amazon's gonna or Caribou's gonna or Caribou or what's it called, Starbucks or whatever those things are. They're gonna keep on selling coffee, and coffee's never gonna run out of style. They're selling it 10 years ago. They're gonna sell it 10 years from now, but they're just re-changing their model or the way they do it. Okay, so for example, a great business has pricing power. So that means like the power to raise its price without a large number of people saying, "Oh, frick, I gotta run out of here." So, for example, it's like this, right? The single most important decision in evaluating a great business is pricing power. And that means, for example, right, if the business have to like pray or like whatever think like oh my god, what would happen if we raise it by like raise their price by 10%? That means they have a terrible business. That's what the book says per se. But overall, that means, let me go back to the Caribou or Starbucks example from that perspective. So from that perspective, let's just say if Caribou or Starbucks raised their price 10%. So from, let's just say it's like $4, right? So what's it called? Let's just say it's like 40 cents or whatever, right? 40 cents, most people be like, damn. But that's not gonna stop them from going to Caribou or Starbucks because people love that stuff and they're gonna keep on buying it. So that's another perspective right there, right? And like to spot a bad business is like this. A bad business is like something like that's in a very highly competitive market. For example, like how do I explain it? Like cars, for example, right? Like stuff like for example, like cars are hard. That's a hard business to go into because like the market is too competitive. Like maybe even airplanes or stuff like that, right? Or like trains or semiconductive stuff or like literally like just pretty much anything that the market is very high or very highly fragmented. So if you don't know what that means, look it up. And those things is like, for example, Caribou and Starbucks, the market is competitive, but those are like the only two big dogs. When it comes to cars, you got Tesla, you got Ford, you got, what's it called, Chevy, you got Hyundai, you got Honda, you got Toyota, you got all them stuff. That's why it's like, whoa. So like, and those are like brand specific because some people literally do not care, right? They will literally just buy like their cars based on what their family been buying for like their whole entire life. So I'm pretty sure you guys are getting the vibe I'm coming from. So look, let me pause for example before I end this, right? So if you made it this far, yo, show your boy some love, share this video to your family member. Go on the link. Give your boy $1. Give me what's it called, $4. Subscribe, whatever. Like, share. But I could care less about that part, right? I prefer the person just sharing. Because if you share that, then you make my day. Because I prefer like the share. Even the dollar tip would be like, oh sweet, that make my day happy. But oh yes, and plus it keeps me activated. So for example, right, I'm not gonna go too much into like the other stuff, like how to like return on equity and all that good stuff, but I'll do that in like a different one, right? So, but what's it called? A great business, right? For example, now to go back to the great business, like they pay dividends or they buy back stocks. So buying back stocks pretty much means like or not. I mean not stocks. Buy shares of their stocks. So that means if they're buying back shares of their stocks, that means they have faith in their company. And when people see a business buy back shares of like in their stocks, that means more people will be likely to buy that thing. That means that means the business really trusts them. And plus, that raises the price up and that gives people money. And dividends pretty much means like let's just say every quarter this business gives you like let's just say like 4% or 2%, whatever the dividends is, right? And depending on now, let's just say you get like $40 or $100 or like $1,000 out of your whatever 4% you have. So that's a beautiful time that's a great business right there. And to reiterate it again, like a simple rule, what's it called? The best time to buy a stock or to buy stocks or whatever, right? Or a crypto or whatever you want to buy, right? Simple rule is be fearful when others are greedy and be greedy when others are fearful. So be fearful when others are greedy, for example, is like, I remember, like, let's just say Dogecoin is going up right now, right? At that time, everybody's buying, right? So the more people buy, the more the price goes up, right? Then like the reason you should be fearful is because if you bought in that time of it going up because you feel like you don't want to miss, it's like boom, then your margin of safety could be like thrown out of whack. Now you're buying at an all-time high and let's just say it drops 30%, right? Like within the next 3 days. And because you didn't use the margin of safety from that perspective, bad, because now for you to even break even, it has to go up another 30%. For something to go up 30%, It's insane for that to go up 30%. That means like it's gonna take you a while to even break even. Now you're stressing like, damn, I just lost 4,000, I just lost 2,000. And be greedy when others are fearful. Some other people are fearful, it's like, damn, this stuff is crashing, it's crashing, it's crashing. Which leads to a bad news is an investor's best friend. It lets you buy a pie or a slice of America's future or the stock market at a marked down price. So I'll say it again, bad news is an investor best friend. So technically, if you have money saved up, you should be waiting for bad news from the perspective of like, yes, bro, yes. I can't wait because as soon as it drops, you're like, damn, Facebook or Amazon or Tesla just dropped over $300. And before, let's just say it was like 800, right? Now you got it at 500. That's like a big discount. You're like, hell yeah, brother. Because you know that's a great business and it's going to go back up eventually. Let's just say it took like 6-7 months, but at least you're in the game. That's you save for $300. And if it goes up to 800 again or even higher, you're just smiling and telling God, thank you. So don't forget, like easiest time to buy a great business is during a bear market. Yo, say less. Yo, I had to go off one time for the boys, man. Yo, I'm blessed. Say less. Yo, keep me activated. Yo, cheers. Whoa, whoa, whoa. Brother,